Welcome, welcome. We'll be starting momentarily.
Morning, everybody.
Welcome, welcome. We'll be starting in just about 2 minutes. So let some people flow in and we'll get all set up. All right, gentlemen, shall we?
I'm ready, man.
All right. Welcome, everybody, for our class on the consideration for your 1031 exchange deadlines. As everyone knows, if you haven't familiar with me, I'm Zachary Kramer from Riverside 1031. We're a qualified intermediary service. I have with me today, great pleasure, Roy Flieger from a RVP Consulting, which is a fantastic financial advisory firm, as well as just general wealth management that you can definitely get into a little bit more. But he would be the one to go to for any 1031 exchange investments that you might want to consider throughout the course of your 1031 exchange. We'll get into exactly where he'll actually fit in these recent events and how deadlines are upcoming and how he would be the one to kind of really go to if you have any questions about what you have on the table to actually pursue as part of a 1031 exchange. Now, again, I have Matthew Rappaport here. It was always a pleasure to be on the class with. He is he's one of the partners at Falcone Rappaport and Berkman, PLLC, a fantastic real estate as well as tax firm. He obviously mans up the tax section of that firm and is just an absolute expert in the terms of 1031 exchanges. And it's basically a fantastic tax advisor to have on your side when it comes to the more complex 1031 exchanges. Now, this is an important disclosure before we get started. This whole presentation here does not constitute any legal or tax advice whatsoever. It's not a solicitation of purchase or anything along those lines. It's essentially just saying that we're informing you of these materials, and that at the end of the day, it is your decision to decide whether to do a 1031 exchange or to attempt to purchase any sort of tenant common interests or DST interests or along anything that we discuss here. It's just for informational purposes. As mentioned before, Matthew Rappaport, Roy Flieger, and myself. And I'd like to get started with 1031 exchanges and just kind of describing how the whole process kind of starts. So before you even consider doing a 1031 exchange, you will have to have owned investment property, whether you originally bought it as a primary residence and you convert it after moving, or you own a vacation home that you only use very, very infrequently throughout the year, and you can even hold it as an Airbnb or something along those lines that does produce some sort of income. At the end of the day, you have to start off with investment property, and what's recommended is that that investment property is held for a reasonable period of time. And a reasonable period of time generally means roughly 2 years. What really should be 2 calendar years prior to jumping into your first 1031 exchange, but it's not required. I would just say that the general rule of thumb is to wait 2 years ahead of doing a 1031 and hold that property for investment use to prove that it's not simply a flip to allow it to qualify for a 1031. Like renting it out for 1 month and then doing a 1031 exchange isn't considered to be holding it for investment use. It should be clear to the IRS that this was an income producing property. But then at the end of the day, when you end up selling that property, you actually might want to consider doing a 1031 just due to the fact that there is incredible capital gains tax tied with most real estate transactions. Typically, if you're looking around New York City, you have Manhattan real estate, Brooklyn real estate, even in Queens, and especially in the Hamptons and Long Island, where these property values have gone up significantly over the course of the past decade or so. And at the end of the day, you're going to be left with a large capital gains tax, which, as most of you know, can vary between 15 to 20% depending upon the actual gain that you're facing for that year. So a 1031 exchange allows you to actually avoid, well, I shouldn't say avoid, more defer, push down the line, the capital gains tax and depreciation recapture that you would face upon the sale of your investment property. And that's essentially the main reason why people would do a 1031. Nobody wants to be constricted by these 45-day rules and 180-day rules. But the whole thing here is that the tax benefits are just so massive and they're so incredible that it's entirely worth it to at least attempt a 1031 exchange just for the fact that your buying power is significantly increased. Now, for those that aren't aware or have never done a 1031 exchange in the past, when you actually close upon the sale of your investment property, you have 45 days from that point to formally identify proper replacement property. And what that means is just a piece of property that's considered like kind to the one that you sold. Meaning if you sold a condo in New York City, you'd be able to buy a vacant lot in Georgia, or you'd be able to buy commercial property out in Virginia. The states don't matter. You're able to swap over from state to state. And while there is some clawback rules in terms of California when you're pulling cash out of there, most states do acquiesce to the idea that 1031 exchanges are entirely tax deferred on both the federal and state level. The only state that does not acknowledge this would be Pennsylvania. And Pennsylvania specifically requires that you actually do pay the capital gains tax that was owed on the sale of that property when you sell it in Pennsylvania.
Oregon also does not recognize 1031.
What was that?
Oregon also
Yes.
does not recognize 1031.
Yes, but again, on the federal level, the federal level is always recognized in terms of tax deferral. Now, besides the 45-day deadline, which we'll get into a little bit more, it's incredibly important when it comes to 1031 exchanges, you have the 180-day period, which is just the standard exchange period. There's no possible way to get an extension unless there's a disaster that occurred. And as all of you are aware, the COVID-19 pandemic is actually considered to be a national disaster in that sense, and was provided relief in the Notice 2020-23. Which we can get into a little bit later, but at the end of the day, the whole point I wanted to get across here is that most of the time, if not 99% of the time, you are not going to be getting an extension on the 180-day period in a typical 1031 exchange. It is 180 days or 6 months flat, and if the exchange is not completed by the 180th day, then you will owe taxes on the proceeds regardless if you purchase property on the following day after that. It must be done within the 6-month period. Now, I'd like to hand it over to my good friend Matthew Rappaport for him to kind of jump into exactly the buying power that you'll be facing when it comes to a 1031 exchange when compared to just simply selling the property, pocketing the cash, and buying another one at your own rate. Matthew, if you would take it away, if you wouldn't mind.
Sure. So I think to illustrate the power of what 1031 can do for you, this is a nice comparison between the left side and the right side in terms of what would happen if you sold your property all cash and took the cash and simply put it in your pocket versus using that cash to reinvest in other real estate. So you'll notice here that depending on how each of these items might apply to you, the tax bite from simply cashing out could be quite significant. Going line by line, I think, with each of these items. Depreciation recapture, let me talk about for a moment what depreciation recapture is and why it exists. So depreciation recapture is basically the theory that the federal government says you're going to buy real estate or you're going to buy other depreciable property like vehicles or equipment or different types of personal property, you get to take a deduction for depreciation. That is based on the theory that the stuff that you have bought will decrease in value over time. So the government assumes that if you have multifamily real estate, it will decrease over a 27.5-year schedule, eventually to nothing and will not become usable anymore. For commercial property, it goes on a 39-year schedule. Thing is, though, as you know, pretty much everybody who's been in real estate for any period of time understands, real estate does not decrease in value to the point where it becomes useless over those periods of time. But nevertheless, the tax code continues to allow depreciation as if that's actually going to happen. So what the government says is, if you eventually go and you sell your property, and the depreciation that we anticipated based on the deductions we gave you did not actually occur, based on the sale price that you enter, you know, based on the contract sale price, then we're going to charge back all of those depreciation deductions to you when you sell. Because when you took those depreciation deductions, those were ordinary deductions. Now, what we're not going to go into today is we're not going to go into the passive activity rules and all sorts of other fancy stuff about whether you could take those deductions and use them a certain way. But depreciation recapture is based on the idea that you took ordinary income deductions, and we're going to charge those deductions back to you when you sell. Because as a matter of fact, based on the contract sale price, it looks like the property was worth something. So first thing they'll do is they'll take the depreciation that you took and they'll charge it all back. When you charge back depreciation on real estate, it'll go one of two ways. To the extent that you did what was known as a cost segregation. And if you don't know what that is, not really a topic for today, but what it allows you to do is it allows you to break down real estate into its component parts, some of which you might be able to depreciate faster than the 27.5 or 39-year schedules that I talked about. That recapture is ordinary income, which is taxed just like your wages that you get on a W-2 if you earn it. And that tax hit's pretty painful. For any depreciation you took on real estate, however, that's charged back at a special rate of 25%, treated as capital gain. That's a major handout because when you took the deduction itself was ordinary, and the gain that you get charged back when you sell is capital gain at 25%, which is an advantage of owning real estate regardless of whether you do a 1031. So that little line that says 25% federal, that is the tax rate on the depreciation recapture figure that's above it, which is $512,821. The 8.82% New York tax is your simple New York state income tax, which does not differentiate between capital and ordinary income. They're both taxed the same. At the top rate, the New York tax is 8.82%. That's a super bracket. So it's when you reach the top bracket in New York State, every dollar gets taxed at 8.82% above that. But every bracket below it is somewhere between about 5.8 and 6.8%. 3.876% New York City tax is the simple New York City income tax. The New York City income tax, again, does not differentiate between capital and ordinary income. It's all taxed the same. So all of those basically add up, and you know, for that purpose, you know, the depreciation recapture is not really going to matter in terms of its character on the state or the city level. It's taxed the same way. The regular capital gain, the $3.987 million that you see right below that, is once you get past depreciation recapture, the rest of the increase in value on the real estate is simple capital gain from, you know, the increase was from market conditions based on how the New York market in this case heated up over the course of your ownership. Your 20% federal is your super bracket for capital gains. Once you hit above the top or the second from the top income tax bracket, you get a kicker on your capital gains where you get an extra 5% added. Regular capital gains rate is 15%. If you are in the lowest tax bracket, capital gains are taxed at 0, but that's very, very rare that somebody in the lowest tax bracket would have any capital gain. Once you hit the second lowest bracket, you're taxed at 50% capital gain, and 20% is the top rate. So those figures that you see for the federal, New York, and New York City tax are on regular capital gains. The 3.8% Medicare surtax is what they call the Obamacare tax. That is only applicable, and this is important for you to know, that tax is only applicable based on whether your property is passive. If your property is active for purposes of the passive activity rules, that 3.8% Medicare surtax does not apply. So you'll see here that when you add all this up, on a $6.5 million sale, your tax bite is close to 1.8 maybe, or almost $1.7 million, which is big. And you have the opportunity to defer that by doing a 1031 exchange. What's the big beneficial effect of that? It means that you get to reinvest in real estate without paying tax, and that means that you get to draw a higher cash flow ultimately. That's the major benefit to it, and it's the reason why 1031 is so popular. Two things before we move on from this slide that are not really reflected on the slide itself, but are very important in the calculations. Number one, if you have New York City real estate that's owned in an S Corp, you have an additional tax that applies, and that's the New York City General Corporation Tax. The General Corporation Tax is another approximately 8.8%. And that tax is, while it is deductible against federal taxes, that tax is going to take another significant bite out of your after-tax return if you sell for cash. And doing a 1031 exchange inside of an S Corp is a major benefit, even more than without the S Corp, because you'll avoid not only all the taxes that you see in front of you, but you'll also avoid the general corporation tax. And a lot of these S Corps are left over from the days before LLCs existed, and folks used to own in C Corps because prior to the Reagan Tax Act in 1986, that was the way that you really wanted to do it. But once the Reagan Tax Act passed, you were out of luck, and you did not have the ability to maneuver out of the corporation without paying tax. So that's a big thing to know. Second big thing to know is, man, oh man, I lost my train of thought. The first one was the S Corp General Corporation Tax, and the second one, I guess Zach, I'll have to think of it. But there was a major second point here, and it totally left me as soon as I got done talking about the S Corp features. Oh, that's right, boot netting, right? The other thing that you have to understand is if you have done heavy borrowing against your property, and that was mostly in the form of cash out refinances, to the extent that your debt exceeds your tax basis on the property, when you sell for cash, that's what's known as phantom income, meaning that the cash you use to pay back the bank is still taxable, which is a major problem. But if you do a 1031 exchange, as long as you borrow the same amount of money to acquire the property that you're buying into as the debt on the property you sold, you still get to defer all of your taxes. So on the $6.5 million property, if you have a $1 million basis and $3 million of debt, you have $2 million of phantom income, meaning the money goes back to the bank, but you're still taxed on it. If you borrow, on the other hand, $3 million or more to buy your replacement property, you will defer all of that phantom income. You won't have to pay a dime. So these are the major reasons why 1031 is so attractive to people, because not only are you deferring taxes, but you're also increasing your purchasing power and you're also increasing your cash flow.
Thank you, Matt. Thank you. For those are, I'd like to kind of jump into what's known as the identification rules. And a lot of people jumping into 1031 exchanges aren't really aware that there are multiple identification rules that you can go with. Most people, when they think of 1031 exchanges, they'll go, oh, I have to find 3 properties within 45 days, and then I buy any one of those 3. When that's not really the case. You can go from a $1 million property to 5 $200,000 properties, or even greater value. The whole idea here, though, is that you properly identify those properties using either what's known as the 3-property rule or the 200% rule. And the 3-property rule is, again, as I mentioned before, the most common, although it's really only meant for if you're going to exchange from a property to another property of equal or greater value and end the exchange right there. When it comes to diversifying portfolios and buying multiple parcels as part of a single exchange with a single relinquished property being sold, you're going to want to go with what's known as the 200% rule, as it gives you a lot of freedom to identify not only a property that you want to buy and multiple properties that you'd want to identify, but it allows you to kind of have backup plans just in case the properties you actually want fall through. And that happens a lot throughout the course of the market, especially if you're coming up on the 45th day and you have no contract of sale for any of the replacement properties yet. You want to make sure you have a good backup plan in mind, which is why the 200% rule comes in such handy, because it allows you to identify double the value of the property you sold. So in my example, where you sell a property for $1 million, you're able to identify up to $2 million worth of real estate, which can include, 10 properties worth $200,000 each, or fractional interests in commercial real estate, interests in Delaware statutory trusts, or there's plenty of other forms of real estate out there that don't require you to actually acquire 100% interest in it. You can acquire fractional interests, and it will be considered like-kind property in a 1031 exchange. Now, the last thing I'll get into on this matter is just that what's known as the 95% rule exception, which is really something you want to avoid if possible, as it requires that if you go over both the 3-property rule and the 200% rule ceiling, you're thrown into the 3rd rule, which is the 95% rule, which states that if you've identified over that amount, you now have to acquire 95% of what you actually identified as part of the 1031 exchange, which can be daunting. And depending upon the actual properties you've identified, if it's multiple pieces of parcels, like let's just say you throw down the phone book to the QI, and the QI says, all right, you've identified 100 properties, and the value is 1,000 times the value of the one that you sold. Your exchange is essentially going to fail unless you could buy 95% of the value that you identified. So that's why it's incredibly important to stick to either the 3-property rule or the 200% rule. You should not go over those 2 ceilings, because if you do, the exchange will most likely not survive an audit unless you acquire every single property involved that you identified. Now, I'd like to obviously hand it over to Matthew again, just to kind of discuss a common 1031 exchange strategy that we like to see, which is what's known as the drop and swap, which is a very, very commonplace when it comes to partnerships that have been around for a long time, and these partners essentially want to go their separate ways upon the sale of their property. And they may not own any of the properties. It might just be, one property that they're both equal partners on as part of an LLC, and they decided that they no longer want to work together, or there's bad blood, or there's something had gone wrong that kind of makes them want to go split into separate ways and kind of invest in separate properties with their 50% interests. Now, typically, in a partnership structure, you wouldn't be able to simply sell the property and do 2 separate exchanges. But with a drop and swap, you're actually able to achieve the goal of starting off with 2 separate tenancy in common sales of the property, and then jump off into two separate exchanges that can occur side by side. And then these two separate exchanges do not have to purchase the same property together. They may take their 50% interest, sell it, and acquire 100% interest in a condo, or turn it into a 5% interest in commercial property. There's no limitation to what you can do once you begin your own 1031 exchange, as long as what you're buying at the end of the day is considered to be investment real property. Now, Matthew, if you wouldn't mind.
Yeah, so probably the most common fact pattern in which I'm called in as tax counsel is properly structuring one of these two transaction formats that you see at the top of your screen in these bullet points. The drop and swap, basically, as Zach mentioned, is all about the idea that if you have people that are in an investment together, they can't do separate things with their sale proceeds unless they restructure their ownership. Because if you have an LLC or a partnership, you must either exchange or cash out together. If you have two parties or three parties or four parties, and let's say you have, it's me, Zach, and Roy, and we're all in an investment, and Roy wants to do an exchange, but Zach and I want to cash out. We're unable to do that by keeping our property inside of a partnership or an LLC. We instead have to convert the ownership of that property to tenancy in common. But it's not as simple as just filing a new deed. What we have to do is we have to make sure that we obey all of the tax requirements for us to create a tenancy in common. And those requirements are extensive. And if you don't have tax counsel, it's very easy to screw up. And that is why I get called in order to make sure that these things are structured correctly. For a swap and drop, it's the mirror side of that problem. It's not a sell side problem, it's a buy side problem. Now on the buy side, what happens is it's me, Zach, and Roy, and I'm doing a 1031, and maybe Zach is doing a 1031, and Roy is coming in with cash. We have to buy into the real estate directly. We can't buy into a partnership together. So the swap and drop basically says that we will all buy into the new property as tenants in common and then later convert to a partnership. So in both of these scenarios, it's very delicate. It requires the observation of a lot of different rules. And if you violate even one of those rules, what you might end up doing is you might blow up the transaction entirely. So you have to be careful. And the other thing to understand is that you really can't pull off a traditional drop and swap or a swap and drop when it comes to S-corps. Instead, with S-corps, you have to get especially creative, and that's beyond the scope of this presentation, but you should at least be aware of that because I get the question quite often, multiple times a year. Oh, we have multiple shareholders of an S-corp, we own real estate, we all want to go in our separate directions. Well, it's not so easy, and we're going to have to talk pretty extensively about that.
Thank you. Now, there's one thing I wanted to just kind of mention, Matthew, which is that if you were to acquire interest in a partnership, so say you want to buy into a partnership as a replacement property in a 1031 exchange, you typically wouldn't be able to do so unless you're already a partner in that partnership and you're acquiring all of the other members' interests. So at the end of the day, you would end up acquiring 100% of that property owned by that partnership. Which again, it's very rare that I haven't really seen a case like that.
Sure. Well, we've done it, but at the same time, it doesn't really fall into the heading of drop and swap or swap and drop.
Yeah.
You're talking about Revenue Ruling 99-6, which is, again, it's a complex form of transaction, but it's the reason why, thankfully, I still get a paycheck is because I have access to this knowledge right off the top of my head, and I can sort of structure things to make sure that they're going to work, and that's one way to do it.
Exactly. Right. Moving on to what's known as the like-kind property in the exchange. Now, I may have mentioned before that, when you're selling a property, it's a condo, let's say, for $1 million in New York City. What's considered to be like-kind is not just another condo. It's not like kind in the sense that you have to go from this type of asset to another exactly identical type of asset, or even within the same building. The idea is like kind property simply means it's real property interests, not personal property interests. You wouldn't be able to go from you wouldn't be able to sell like a short-term lease held interest and jump into a 1031 exchange. Same way you wouldn't be able to buy into it. You actually have to purchase a lease held interest of 30 years or more, and at that point, it's considered to be a long-term lease held interest, which is then like kind to other forms of real property. But typically in the standard investors exchange, they would simply go from owning a condo to perhaps buying a multifamily or buying vacant land for them to construct upon, or even farmland. At the end of the day, there's tons of different options out there for these investors to look into, and they're not just simply limited to you owning and managing real property. As Roy will get into just momentarily, there are a lot of different opportunities out there for people doing a 1031 exchange that allows them to kind of approach this in a more, well, I'm going to own these properties, by name, but I'm actually going to have a trustee managing the property, or I'm going to have some sort of captain in the tenancy and common realm to kind of lead me through exactly what needs to be done to the property. At the end of the day, you may consider this what's known as a mailbox money, which is just money you receive in the mail without actually having to manage the property too extensively. But again, at the end of the day, these are just options we want to make you aware of, and they are coming in handy a lot when it comes to exchangers kind of approaching this 45th day or this identification deadline on July 15th and not having anything as a backup plan, or not being in contract for the property they really want to buy and being nervous about the tax consequences if that property were to fail. It's always a good idea to have these backups on the table just in case something were to happen with your primary plan of purchase. We've seen cases where there's properties being sold all around the country and there's either title issues or there's environmental concerns or there's a massive incident at the house, or like a kitchen fire, something that causes the house to dramatically basically either reduce its value or to the point where it can't close within the 6-month window. And that's the key part you want to keep in mind, is that if you don't buy within the 6-month window, doesn't matter if you're still in contract for it, it's not going to count as part of a 1031 if you don't buy it within 180 days. Now, I'd like to hand it over to my good friend Roy Flager, who's going to be going into the different types of 1031 investments that exchangers can look to, and especially why they should be going to him in particular to kind of discuss these opportunities more in depth and have a greater understanding about what's on the table and available to them in these instances.
Thank you, Zach, and thank you, Matt, and thank you, everybody, for your time. So just a quick introduction to myself. My name is Roy Flager. I'm the president and a financial consultant of RVP2 Consulting. So my goal is very simple. My goal is to be a consultant to you, your clients, or whoever may be in your life that needs guidance on 1031 exchanges or just general financial planning. I've worked with Zach and Matt for many years now, and over the course of time, we've all found that there's just common underlying things that take place throughout everybody's lives that just some simple consulting can go a long way. A little hand-holding, a little extra guidance winds up leaving people in a more favorable experience, whether that's on the tax consequences of a transaction or just setting themselves up, like Zach was explaining, into the proper LLC structure and things like that. So really the purpose of today's webinar, as you're hearing, there's a lot of considerations that we're going through, coming just 8 days away for the extended deadline of our identification period. So what I'm going to go over are the different types of properties that you can exchange into that you may not be aware that even existed as options. So on this slide, you can see you have timber rights, mining, oil, riparian, I hope I said that properly, tenant in common, transferable development rights, and others. So those are all different sectors and types of things that you might be able to exchange into that you may not have even known existed. So programs that I work with are tenant in common investments. So it could be a self-storage facility down in South Carolina for a possible cash out refinance in the future. So it starts off with very low income. And then for those of you that are unfamiliar with tenant in common, Matthew is definitely more familiar with the revenue procedures and the actual formal legalities of it. But under 2002-22, it shows that these qualify for 1031 exchanges. So typically the investment structure is, one, you need unanimous consent from the investors to manage or make substantial decisions around that property. If you're going to hire a new property manager, if you're going to cash out and refinance that property, You're going to wind up making significant CapEx improvements, things like that. So it takes a lot of energy and effort to get, if you have up to 35 people invested, you have to get 35 people to agree on what to do with that property. The other thing is the banks have to lend to that. So sometimes, unless you're working with an institutional sponsor or a company that operates in this world, it could wind up being very difficult to get a tenant in common replacement property for your exchange. I know I was speaking with one woman on the West Coast where she was working with these gentlemen. She's known for over a decade, but they were having such trouble getting financing for their tenant in common investment. She wound up listing the Delaware Statutory Trust as a backup, which is a perfect segue for where we're going next, which is also the Delaware Statutory Trust. So tenant in common is really an investment structure. It's not the actual replacement property. It's just how you own the replacement property. All of the restrictions on what you can and can't do or can and can't buy are still there for the actual physical real estate. Tenant in common is just a way. So now if Zach, Matt, and myself all said, hey, we all sold a property, we want to buy something bigger, we could all come in as 3 separate investors, tenant in common, and buy a larger piece as 3 separate investors through that way. And so tenant in common is a possible solution, and there are more structured investments that allow you to be passive and still invest into real estate that qualifies for 1031 exchanges. Now, the Delaware Statutory Trust, this is a world that I operate and breathe in every single hour of every single day. So a Delaware Statutory Trust is basically a trust structure that qualifies for 1031 exchanges under Revenue Ruling 2004-86. So these were really created as an alternative to the tenant in common. Why? Because you need unanimous consent. You have to, you're only allowed 35 investors. The banks were having difficulty lending to those types of programs. Excuse me. So they created the DST as an alternative solution. So the DST, the Delaware Statutory Trust, is basically a trust structure that will own a property or properties inside of the trust that you as an investor or you can guide your clients to invest for their 1031 exchange. Now, the great thing about DSTs is that they come pre-packaged, meaning you will know everything about that program from day one. If it's a multifamily, you'll know when it was built, what it was appraised for, what the occupancy is, what the financial forecasts are, what the loan terms are. Is it 5 years interest only, 5 years amortization? Is it 10 years interest only? So it allows the investor to make a very well-educated decision on what they're buying, right? Because if you look at New York, especially after COVID and some current events and all that, it's going to be very difficult to underwrite a property, right? Are you going to be able to rent it if it's vacant? What rent roll will you be able to get? Has the property appreciated? There's a lot to consider. Where if you came to me and your client's accredited investor and you said, hey, I want to buy a DST, I'll be able to point out exactly what you're getting. And I could, like, for instance, I'm working with a client that right now he wants Class A multifamily, Class B multifamily, and self-storage. I can match his specific portfolio needs to exactly what he wants. And the other thing too is, so the DSTs come built in with debt, meaning if you have a specific debt replacement requirement, the DST can help match that. So for instance, if you sold $1 million property and you had $500,000 of equity and $500,000 of debt, in a 1031 exchange, the 2 rules that I like to follow are you have to go equal and up in value. So you have to sell, you have to buy for at least $1 million or more, and you need to go equal or up in equity. So you need to replace at least $500,000 of equity. So when you sell that $1 million building, you have to take your $500,000 of equity proceeds and buy at least $1 million property with that equity proceeds. Otherwise, like Matt said, you might have boot. So the DST comes pre-packaged with debt, meaning a DST could have a 50% LTV. So if you put in $500,000 into a Delaware Statutory Trust the non-recourse debt component would wind up buying you $1 million worth of real estate, therefore satisfying your 1031 exchange.
Oh, and Roy, just to give you a good example on this, we had a woman that I worked with who was a little bit, elderly. She doesn't work anymore. Her income stream wasn't nearly what it used to be when she had acquired her first property in 1031 exchange. And when she went to go try out and get a loan, they told her that it just simply wouldn't work out for the size of loan that she needed. So when she turned to DSTs, that's actually when the prepackaged debt came into great use for her, because she didn't have to go out and talk to a mortgage broker. She simply had to go and jump into a DST set up through you guys, which was essentially just already prepackaged for her. She's got the debt in her name, she's got the equity in the property, and her exchange was 100% successful, even though she wouldn't have qualified for a loan had she done this without a DST structure.
Yeah, and that's exactly it. So and that's what really, like, that's why the DST is so powerful. So the biggest thing to note about the DSTs is that they're for accredited investors, which means that you have to have $1 million of net worth or have $200,000 of income the previous 2 years and year to come. Most people, especially in our markets, they bought a brownstone in Brooklyn for $400,000 or even less than that in the 70s, and now it's worth several million. So most of the people locally will wind up qualifying to be eligible for DSTs. And going back to the whole title of this, considerations for the deadline, right? Exactly like Zach said, the DST became the perfect solution because it wound up erasing headaches. Because, again, going to that $1 million example, so if you sold that $1 million building, you have $500,000 of equity to replace and $500,000 of debt to replace. Another tremendous benefit is that there's a very low minimum on Delaware statutory trusts. You only need $100,000 to invest into a DST for 1031 exchanges. So now that $500,000 of equity, instead of maybe finding one single triple net lease building that you can buy, you could actually diversify into 5 different DSTs that range from institutional quality, Class A multifamily, Class B multifamily, medical office building, self-storage, student housing, almost any sector and any geographic location we have opportunities in, because I believe in the power of diversification. So it's not the things that we don't know that's going to hurt us. It's the things that we do know that just ain't so, right? It's the things that we're 100% sure about, what I call the God forbid moments. And then all of a sudden, God forbid, there's a drop in occupancy. At least you have the ability to diversify yourself across very high quality institutional style assets that you're 100% passive in. So again, I keep reiterating this because going back to the identification rules, you have 3 identification rules. The first one is your 3 property rule. What often happens is you'll be courting your client and they'll have property A. That's their ideal property. That's what they want to buy. And then, well, if that one doesn't work out, I'll get property B. Property B will be okay. I won't be mad if I get property B. Property doesn't work out. What happens if both don't work out? Because that first slide that Matt showed us went over is pretty ugly, and the only one that's happy in that regard is Uncle Sam. He's going to get all of the taxes. So the DST is the perfect emergency parachute. You're not locked in. And, my job is explaining to you and your clients to make sure that this is a good fit for you, right? But at the end of the day, if it was investing in something passive and illiquid for 7 years, rather than giving $1.5 million to the government, more people are comfortable putting their feet up and waiting to make a decision 7 years from now. The other thing I'll just touch on, then I'll give it back to Zach and Matt, is the 200% rule. So the 200% rule, basically, if you sold for $1 million, you can identify as many properties as possible for up to $2 million. So that's important because let's just say you wound up identifying 3 $400,000 properties, right? So now you have $1.2 million worth of property, but you're still in the 3 property rule. Well, mathematically, you still have $800,000 worth of 200% rule left. So we could back up 2 of your properties, $400,000 each in the 200% rule with the DST. So it just gives you the opportunity to put that trampoline underneath you. So God forbid something happens, the sale doesn't close, you can't get financing. We know the DST is there to catch you.
Thank you, Roy. Thank you. And if I'm not mistaken, if you would basically get contacted early enough in the transaction, you can actually reserve some sort of spot in the DST for a short period of time, just in case to see if the property that they want to pursue falls through, or if it's essentially going to work out, or if it's not going to work out. They can always have the DST to kind of jump into. In the cases where the DST isn't entirely open and accepting investments from everybody, essentially, there's always ways to kind of.
Exactly. Yeah. So because of my relationship with the sponsors, I get to sit there and work with them. And if they, so if you come to me early enough and you say, hey, I need X amount of time, what is going to be on the menu within that period of time that I might wind up identifying, I'll be able to work with you and map out exactly what investments I'll have on my platform that we will be able to use for the future. So I actually worked with a gentleman. He owned like some type of manufacturing business who just sold some real estate. But one of his business partners that was a significant business, he was waiting to see if they would wind up making it through some of their economic hardships. So we actually identified DSTs, and knock on wood, it worked out like this, because sometimes there's a demand for that we just can't control. But at the end of the day, the way we built his identification form, he had options all the way up until day 180 to choose. Now, he wound up going with the exchange because he just wanted to stay more liquid. But that's the power of working with somebody like Zach, Matt, and I, is because we can structure your exchange to last as long as possible for you to make the most optimal decision for yourself financially. And, and the one other thing that I just want to throw out there is the DSTs are in a liquid product. So if you came to me and just bought a straight DST, you're expected to be in that program for 7 to 10 years. And something that I'm sure Matt could expand on too is, like, what are our liquidity options, right? When you're in the real estate world, it's obviously the obvious answer is, well, cash out refinance, right? You have a property, there's equity in it, put some debt on it, take the money out. Matt definitely can speak to this more than I will, but there's obviously some timing restrictions or, best practices on when you want to do that. In the DST world, we also have what's called the 721 upREIT product, where it initially starts as a DST. So sponsors like JLL, Johns Lang LaSalle, they will come out and they'll buy a multifamily in Atlanta, Georgia, or Chandler, Arizona. After 2 years, you'll wind up getting operating units of their $3 billion REIT. And after you hold those operating units for one year, you now get shares of their REIT that you can sell at your own accord, which will be taxable at that time, but you get to control the liquidity rather than be locked in the real estate the entire time. So I'll give it back to you guys. And if any questions come up, I'm happy to answer them.
Thank you, Roy. Thank you. So there's one last topic we kind of cover, just because it's very interesting, comes up very often in 1031 exchanges as being like this is a great idea. My brother is selling a property here. I want to buy it from him as part of a 1031 exchange. That way he's happy at the end of the day, he has cash, and I'm happy because my sale was tax deferred because I bought his property as my replacement property. It becomes very, very difficult to kind of maneuver a replacement property that's being sold by a relative, specifically a relative that's a direct descendant or is your parents, grandparents, essentially a blood relative, or somebody, if you're buying property from essentially yourself, if you are a 50% owner in a partnership that's buying property from you as an individual, that wouldn't work either. That's what's known as a related party exchange. And related party exchanges are dangerous in the sense that they have a little bit of extra rules tied to them in order to make them survive an audit. Now, if you're buying a property from a relative, it's a little bit more of an issue than if you're simply selling a property to a relative. As selling a property to a relative does require that that relative that purchased the property from you then holds on to that property for 2 years, and that you have a successful exchange, and I believe that you actually have to hold on to the property you bought for another 2 years as well. If you sell the property, then at that point, the related party exchange becomes a little bit more at risk in the case of an audit. I wouldn't necessarily say that it would fail outright, but you generally want to avoid selling property too quickly when there's a related party involved on the sale of your relinquished property. Now, if you're buying property from a relative, that's when it becomes a related party exchange and must be declared as such when you file the form at the end of the year for like-kind exchanges. Now, related party exchanges, the main reason that they're considered to be dangerous in a sense is that if you buy a property from a relative, that relative then must do their own 1031 exchange and buy from a third party. Or if they were to buy from a relative, I wouldn't necessarily say that that would fail audit, but then that other relative would then have to do another 1031 exchange, and it would have to continue, and it'll be a large chain. And generally, if any of those failed, then anything that happened prior to that with the relatives and the related party exchanges would also fail. So, end of the day, if there's two relatives involved and you're buying property from one of them, then that relative you bought property from must do a 1031, must succeed, and must buy property from a third party that is unrelated to them. And at that point, you could survive a 1031 audit by the IRS. Really, we've seen a lot of situations where an exchange is attempted by this relative that sold property to the exchanger, and they ended up not doing it, or there was net operating losses for that year that kind of offset the gain they faced. So at the end of the day, the IRS gets paid nothing, the 1031 exchange succeeds, and the relative doesn't have to do a 1031 because he's wiped out his entire gain because he strategically sold this property in that year he was recognizing the loss. It did not survive in the courts, not whatsoever. There was a large fight over it in the 1031 industry that it kind of should have worked, but at the end of the day, the IRS takes a very harsh stance when it comes to related party exchanges, and they generally frown upon it just because there's a lot of room for abuse. There's a lot of areas that are considered to be dangerous for the average exchanger to go into without having a very detailed plan about what's going to be sold, what's going to be purchased, and that it's not simply viewed as a rescue purchase, meaning, oh, my 44th day is here. Tomorrow the exchange, the identification period will expire. My brother is going to sell me his property that he wasn't thinking of selling before, that I wasn't thinking of buying before, but I'm just coincidentally able to take it and purchase it and have a successful exchange. And at that point, that's where the abuse lies, is that, well, the IRS would have gotten the cash from the failed exchange had the brother not sold his property to his brother. At the end of the day, that's where the IRS will go after you. And if it's a business partner, it's a different story, not related. They don't really look into that kind of thing too much. But when it comes to family and relatives and blood connections, there's a lot of room for tax maneuverability and kind of avoiding the largest tax hits that you would typically face just because your family happens to own property and kind of bail you out of these 1031s that would have otherwise failed. Matt, if you wanted to jump in here, I'm sure there's a lot of instances that you've seen or any explanations that you wanted to go over regarding if there's other issues with the related party exchanges, or if you would even generally recommend it in the first place to anyone that has a plan to have a related party exchange. Might be on mute.
Well, my keyboard unmuting wasn't working, but at any rate, given that I'm currently feeding my newborn daughter, I will say this. Generally, the related party exchanges, it's a per se rule, right? So if you're going to buy replacement property from a relative, as you mentioned, you have to, daisy chain your 1031. The relative has to do a 1031 in order for it to succeed. If you don't pull that off, the entire exchange on both sides, the purchase from your relative and your original sale, are both taxable per se. So it's important when you're doing anything with a related party to get the proper tax and legal advice, because if you don't, you can end up with the entirety of it taxable. The other thing I was going to mention was, in terms of audits, the federal government's, they have problems with their budget right now. I always tell people, look, if people ask me, what are my chances of getting audited? I always turn to them and I tell them 100%. Don't come to me if you want to play audit roulette unless you want to give me a written acknowledgement that I wasn't the one who told you to do it. Other than that, when I plan, I assume everything's getting audited. So the thing is, though, in terms of what the reality on the ground is, the federal government is not auditing 1031s as often as New York State. New York State is auditing 1031s significantly more often than the federal government. And New York State is looking at pretty interesting issues. You know, Roy mentioned cash out refinances. That has been popular, that the New York State has looked at cash out refinances and said, we don't necessarily like cash out refinances being done in close proximity to a 1031. The law is not really on the government side on that. A lot of the case law favors the taxpayer, but New York State's deciding to take a hard look at it anyway. I have 3 of those audits in progress at the moment. So, you know, the thing that you have to do is you have to understand it's never a bad idea to get the proper tax and or legal advice in connection with 1031. And you should be wary of what's out there. You know, the idea that if you want to get fancy with it to any extent, it's probably a good idea at least to run these questions by an expert. And the advantage of working with Zach and Roy is that they can recognize these situations for you. You know, it's not necessarily that you have to come to me right from the beginning, although that's never going to be a bad idea. If you have Zach and Roy working with you, they can tell you when you're going to need to consult somebody like that.
All right, thank you, Matt. Thank you. Let me see here. If there's anybody that has any additional questions that we haven't gone over, or if there's any particular topics you'd like us to cover in the future, feel free to let us know in the comments below. There was actually one question, which was, if New Jersey has something like this in terms of a 1031 exchange and depreciation recapture and capital gains deferral, yes. Like we mentioned before, every single state throughout the country, with the exception of Pennsylvania and Oregon, they actually do recognize 1031 exchanges. And while some states do take a harsher stance, if you're thinking of you know, New York State auditing a lot of 1031s, but losing a lot in the courts, as well as California having clawback provisions to pull that capital gains tax that left their borders eventually when that property is then sold outside of a 1031. There's a lot of things to keep in mind, but people like you know, myself, Roy, and Matthew are all very familiar with the state level clawbacks and state level guidelines regarding 1031 exchanges, and we can let you know if there's any possible issues involved. The most common thing that we'll see is if a non-New York State resident were to sell property in New York, they would typically have to have some sort of withholding done for the proceeds. While a 1031 exchange actually grants an what's called an exception to that rule, allowing you to take the full proceeds and reinvest them into a new property. And if the exchange is successful, then that withholding, that capital gains on both the state and federal level, as well as the depreciation recapture, is deferred until a later date. That later date being specifically either you selling that new property outside of a 1031, or you eventually passing on with your heirs inheriting that property with a stepped up basis, in which case it's wiped clean essentially. Now, Roy, Matt, I'd like to thank you once again for joining me here on this class. It's always a pleasure to have you both on. You're both incredible, you know, with knowledge on the subject, and both have plenty of years in the industry. And I honestly am just happy to be able to learn from great people like you guys, and have everyone around Riverside as well. I'm sure they're all very appreciative of your expertise in these matters.
My pleasure, Zach, and thank you everybody for your time. And thank you for putting this together and allowing us on the platform.
Of course, of course. And obviously we'll be sending everybody that wants a copy of the slide deck, a copy right after this class. If you want a recording of this class, feel free to reach out to me. I'd be happy to send you the link to it as well. And everybody stay safe out there and have a wonderful day.
Take care, everybody. Thank you.